QuickBooks Pro Desktop 2021 reversing entry, accrued interest with the help of Excel. Let's get into it with Intuit's QuickBooks Pro Desktop 2021. Here we are in our Get Great Guitar homepage. We currently have the open windows open. You can open the open windows by going to the view dropdown, selecting the open windows list. We're going to be opening up our financial statement reports, the balance sheet and the income statement, by going to the reports dropdown, company and financial, and go on down to that balance sheet standard. Changing the dates up top in the customized reports from 01/01/21 to 02/28/21, February 28th being our cutoff date. That's the date as of that we want our financial statements to be correct as of, with the help and use of our adjusting entries. Then we're going to go to the reports dropdown, company and financial, open up that profit and loss, the P&L, and that's going to be on 01/01/21 to 02/28/21 for the 2-month time period. Now, last time we entered an adjusting entry with the help of our little Excel worksheet over here, just to give a better look at it in terms of what the effect of it will be. That was a debit to interest expense and a credit to interest payable, representing the fact that according to our amortization table over here, and if you don't have access to these, you should have access to these Excel worksheets so you can take a look at them. If you do not, that's okay. You could follow along here as well. But here's our short-term Excel worksheet where we had interest that's going to be due on March of next year. And we wanted to pull in 15 days of it into the current time period because 15 days of it was in February that has been accrued. So to be on a proper accrual basis, we should recognize the $56 of interest expense, even though we haven't paid it and will not pay it until next month. Just like if we were to have like rent or something like that and we didn't have to pay it for this month, and we paid rent like every 6 months or something, we'd still have incurred the rent. So we should be recording the expense, and the other side would be the payable. Now, the problem with this is that now when you think about paying it, so now we've got this payable on the books here. If I go to the balance sheet, I'm going to say, okay, now we've got this interest payable on the books. The problem is if you go back to the normal kind of process in terms of the accounting process for the bookkeeping system, the bookkeeper's now going to say, hey, what is that interest payable? I have no idea what to do with that. I mean, does that mess up my loan payments? Because you notice what the bookkeeper plans to do is make a payment next month. And they're going to make a payment in accordance with this schedule. And if they look at this schedule and make the payment as we saw with the loan payment, they would have to write a check, and they're already dealing with 2 accounts, meaning they would have to write a check, they would have to decrease the checking account, and then they've got to apply out the proper interest and principal, which would be the $112.50 and the principal of this amount. So in other words, let's just do the journal entries on the right to see what we're talking about, what kind of the problem would be here. So let's assume that we didn't have the accrual in place and we were just going to record an interest payment according to this amortization schedule. What would happen is I'm going to do this with debits and credits. I'm going to put some of the credits on top because I think that's the easiest way to do it. But it would be the same for the check, the check that we would write when we wrote a check for the loan payments over here on the first tab, right? When we wrote these 2 checks, similar process. So if there was no accrual, it would look something like this. We'd say, well, cash would be going down. It would be a credit and that would be a decrease to cash. So cash would be decreasing by that 117 or that 1,742 about. It's rounded. We'd cut off the pennies over here. And then we'd have the interest expense would be for the amount on this table. So it'd be for that amount. And then the principal reduction, which would be loan payable, would be this amount. And so that would be going down. That would decrease the loan payable. And these 2 debits add up to that credit. This would be the normal transaction. Cash goes down, loan payable goes down, and interest expense goes up. But now we have this payable on the books now, and that kind of muddies up the water. So if I didn't reverse this to properly record this transaction, it's more complicated now. So to record the transaction, we'd say, well, cash would still be going down by the 1,742. And then we'd have the interest expense. Well, let's do this. But we'd also have the interest payable that needs to go down because it's on the books. It needs to go away because now we have this payable and now we're paying off the payable. So the payable's on the books as a credit. We would need to debit the payable, which would be for that $56.25. And then we would have the interest expense, which would be only for half the interest because half of this month happened last period. So the interest expense would only be, once again, the $56.25. We'd have to split it out between the two periods. And then we'd have the loan payable, which is going to be the same 1630. So we'd have to break out basically this interest expense. And so this will complicate the journal entry for a journal entry that was already fairly complex. And even if you think about it on a more simplified basis, you might have the bookkeeping process just simply record a transaction that would credit cash for the 1642 and debit loan payable for the same amount, and then just have us record the adjusting entries for interest and any kind of breakout of accrued interest at the end of the month. So in any case, this added piece kind of complicates things. I don't want to complicate things for the data entry side of things. I want it to be as easy as possible. That's why we're going to basically reverse this transaction. That's the idea of the reversing entries. Okay, so let's see what that would look like then, just in terms of Excel first, because this is going to make it more kind of transparent to see. So if I go back on over to our worksheet, what I want to do is say, okay, this is what I want to make the financial statements correct. And then I'm going to look at two more columns to basically look at the reversing entries, and these are the ones that I'm gonna reverse back out to see what happens to get us back to where it'll be logistically easy for the bookkeeper to keep on doing their normal process of data input. So what I'm gonna do is I'm gonna add two columns to do this. I'm gonna put my cursor on I, I'm gonna highlight over to J or select over, left click and insert. I'm gonna insert two columns. And so now let's do some formatting here. So I'll just do some formatting. These are going to be the reversing entries. So I'm going to call them the reversing entries. And this is going to be the trial balance. And this is as of the first day after the day of the cutoff, meaning the first day of the next period, which I'm going to say is 03/01/21. Now I'm just going to do some formatting here. I'd like to just basically format this column in the same format as this column. So I'm going to select this entire column here, and I'm going to go to the Home tab, Clipboard Format Painter, and just paintbrush this over. This is, again, we're doing Excel formatting, so you will have access to this worksheet if you're working along. It'll be pre-formatted if you want to not do all this formatting, but just to see how you can put this together. Then we're going to go to this column. I want to paintbrush this on over. So I'm going to hit the old paintbrush up top and paintbrush that over. And then I'm going to do the sum function here. This is going to be equal to our adjusting column plus the reversing entry. So the reversing entry is going to take us from where we stood as of the point in time the financial statements were created. And then we're going to reverse out as of the first day of the next period. And then we're going to copy that down. I'm just going to autofill that down like so. And then I'll copy these bottom across as well. I'm just going to autofill that across. And so there we have it. So now I want to just basically reverse exactly what happened here. So we had a debit to interest expense and a credit to interest payable. Now these reversing entries will look unnatural. They'll look weird because normally we don't credit an expense. They only go up typically in the debit direction. So these are going to look funny, but hopefully you'll be able to see why logistically they kind of work in order to separate our duties between the adjusting process and the period end process of data input. So I'm going to right click here, I'm going to insert, and then I'm going to say that this is going to be an adjusting entry, and we can number them like 1, and this is going to be reversing entry, and I'm going to say this is 2, and I'll just number them across so we can kind of differentiate between the two. Now I'm going to use the same formatting we did up top, meaning I'm just going to say this debit, or not the debit, but the expense on top, interest on the bottom, and then I'll flip the debits and credits. So I'm going to flip the debits and credits. So in other words, I'm not going to reverse the account order so that the debits will be on top. You can do so with one that's this small, but when you start doing that with really long transactions, it's a lot easier to just put the same ordering of the accounts and then reverse the debits and credits. That's a lot easier to do. And it'll look funny, but a lot easier to do. Okay, so now we're going to record this out. So I'm going to go down to the interest expense down here, I'm going to say this will be an interest expense, and this is going to be equal to this 56, and it's going to be a credit, which is funny. And then we're going to go to the interest payable, and we're going to reverse that out. Interest payable, I'm going to reverse that out, and that'll go back down to 0. Now also note that as we reverse this on the income statement side of things, if we ran the report for the 3-month time period, January through March, and we'll do this in QuickBooks. This will make more sense when we run it in QuickBooks. And I know it's kind of complex to look at it in Excel like this, but it's a lot more transparent to see it this way. We're going to have to zoom into reports and whatnot to see it in QuickBooks. So we'll do that next time. But just realize that now, if we think about this, then if we ran the report in QuickBooks for 3 months, January, February, March, our cutoff date being the end of February, and then the reversing entry entered in March, this is basically what our income statement would look like. However, what if we were running the income statement just for March, just the month of March, as we kind of would, or you would think about if the year had ended, you had the closing process, and then you were running it the next January. Then you would only have this amount, a negative expense in that current month. So let's see if we can reflect that here in Excel, just to show us what's going on. I'm going to put my cursor on L, right click, I'm going to insert another tab, and then all the way down, I'm going to say this is going to be equal to the same trial balance. I'm going to say this is the trial balance for March, just March. Whereas this one is the year-to-date March. So 3 months, this is just 1 month. So then I'm going to be copying this down. So let's copy that on down. Take it all the way down to draws, and that's it. And then the closing process would be that all of this stuff, and this is going to happen automatically in QuickBooks. Most people don't really understand that, but if you see it transparently, or if you see it in a transparent software like Excel, then it might make more sense when you kind of change the dates in QuickBooks. So if we took then, these are the income statement that we're going to close out. We're going to close these out basically to the equity section. So in other words, if I looked at just March, then I'm going to say this was going to be the sum equals the sum of the prior equity, this number, and all of this. And then if I was to basically copy across our debits and credits and our net income, copying that across with the auto fill handle, if I can grab that fill handle. So now it's out of balance by the 56, which of course is our reversing entry. So then if I copy now on this cell, instead of adding these two up, I'm just going to show our adjustments that are happening in the month of March. So I'm going to say this is just going to equal the blue column, and I'm going to copy that down. And so now we have our 56 there, and now we have a negative net income. Let's just put brackets around this thing. So I'm going to bracket this. Let's go ahead and go to here and put the brackets around there. So there we have it. So now this is just the month of March. So if you look at just March, then all we have in there is this negative expense, which is weird. Like, you shouldn't really have a negative expense. But once we actually make the payment, meaning once we make this payment, and they record it, if they record it this way, the normal way that they record it, they're going to be debiting interest expense by the 113 or the 112.50 when they do that recording. So as of 3/15, we'll be back correct again, because they'll debit this account by the full amount, and then we'll have the 56.25 or 56 whatever positive amount as of that point in time. So in other words, it's wrong right now, really, on an accrual basis, but it will be right on the 15th. And that's in alignment with kind of our system to be correct as of a point in times for certain things, so that we can make the logistic process easier. So if you give this to basically a bookkeeper, they're going to say, hey, I got a negative expense, that's really weird. But you say, hey, that's fine, because you just record things like you normally do, and it'll be correct after you make the next payment. And that might be better than having this kind of payable hanging around, where they're going to say, hey, I don't understand that payable, and they may not be able to record the next transaction like basically they normally would. So that's kind of the idea of the adjusting entry process. And again, I know this worksheet's a little bit confusing to look at, but it really is a lot more transparent to kind of see what's going on with this whole, because we're kind of combining together the closing process, the adjusting entries, and the reversing entries. And when you do it in QuickBooks, you can't really see it broken out. And so basically this income statement right here is the proper income statement on an accrual basis as of the cutoff date, 2/28. This income statement represents the 3-month time period after we do our reversing entry, and this income statement represents the 1-month time period after having closed out the prior 2 months, and now you just have the income statement for that one period, that 1 month of March, which only includes this negative amount. We'll see that when we do these transactions in QuickBooks next time, and then we run the reports for these various dates.